Hello everybody, my name is Mark. Welcome to another video in my video series, The Profitable Investor. In this video, I'm going to share one of my big secret strategies. I call it the covered call growth strategy. It is a great growth strategy for the conservative investor who wants to use an aggressive, maybe I shouldn't say aggressive, but who wants to go for some more returns with some moderate to low risk. So without further ado, let's jump in and let's talk about it. I use this cover call strategy on this ETF called Nugget, and the crux of this video, I'm going to talk about what I did with Nugget and how this covered call strategy works. So I made $763.39 from December 27th to April 3rd. That's barely over 3 months, and at the time I had about $7,600 in my account, so I made almost 10% in that time on that particular strategy. So it's good. It's something I plan to use again. So without further ado, let's get going. So the first thing you want to do is you want to find volatile investments with liquid options. And like I said, I'm going to talk about Nugget. It is a nice volatile investment with liquid options. And you can see these are the levels of support and resistance. The high is between $45 and $50, the low being around the $25 to the $30 range. So you have all of this area where you can make some money, and so it's great, and all of that volatility is priced into the premium of the options. Okay, here's a list of the options. Okay, and you can see that the spreads are nice and tight. The 32, it looks like $32.50. Call options, the bid is $271, the ask is $275. That's only $4 difference. The 33s, again, only $4, and the 33.50s are only $4, and that's nice and small. That's exactly what you want. These are 22-day options, expires in 22 days. The last one was 15 days. These ones, the spreads are 15 cents. That's not that bad. I've seen much worse than 15 cents. So that's what you want. Nice liquid option, and you can see there's decent volume there. Looks like, well, this one, the volume itself is not high, but the option interest is high. Option interest is how many contracts there are out there waiting to be bought or sold, already written. Okay, so good liquid options is what you want. Okay, now if you don't like Nugget, I did another nice thing for you guys. I put this link, and I apologize that this is a video and you may have to type this in by hand, but this link will guide you to 56 different leveraged ETFs, and you can pick any one of those. They all have good volatilities. Pick one that you like and then start investing in that one. Use the cover call strategy, which I'm about to explain right here. Okay, so the next thing you do after you found your volatile investment is you want to identify levels of support. So these are the levels of support, and the levels of support are at about the $25 at a low to $30 range. And after you've done that, then you want to check the option premiums at those support levels. So here, the $30 calls, the premiums are $4.20 for the bid, $4.30 for the ask. So you would get $420, anywhere between $420 to $430. So we'll use the middle. We'll say $425. That's how much you would get if you were to sell a call option at that level. Okay, and so to calculate your profit, your max profit, the first thing you do is you take that $30 call option and you add the premium that you would get if you were to sell it. That's $425, and that brings you to $34.25. Okay, and then you take that $34.25, you subtract the price that the stock or ETF is trading at. That's $33.32. You come up with $93, and that's $93 per contract. If you were to buy 200 shares and sell 2 call options, you'd get $186, and so forth. Okay, so your max profit is $93 per contract, or 2.79% return, and that is in a grand total of 15 days. Now, I think 2.79% return in 15 days is really good, don't you? So I like it, and I do this a lot. Next thing you want to do is, let's say you're not comfortable with the $30 strike price. Let's say you want to be safe and you want to go down to the low end, $25. Well, unfortunately, this is the 15-day. If you were to take those premiums and add it to the $25 strike price, you get $33.35, and then $33.35 is minus $33.32 is only $3, and so you're barely making even 1/10. That's less than 0.1%, and you can kiss that money bye-bye to your commissions. Okay, Ameritrade is $6.95 commission, so kiss that money bye-bye. So not even worth it to do that. So you would have to go further out. You'd have to sell maybe stock options 2 months or 3 months out, and then you would get some better return. But I prefer shorter term options because they're more flexible. Okay, so after you have done that, then you want to scale in slowly. So if you're comfortable with those $30 levels of support and you feel confident that the price of the stock or ETF in this case is going to hold above $30, you scale in slowly, and my recommendation is 25% of your money or less. Okay, so you buy in multiples of 100 shares. So if you buy 100 shares, you can sell 1 contract or 1 call option. If you bought 200 shares, you would sell 2 call options. 300 shares, 3 call options. And the shares cover the call options. That's why it's called covered calls. So if the price of the stock goes above the strike price, which these call options are in the money, then what's going to happen is your shares are going to be automatically sold on the day of expiration, and that's what you want. That's how you get the maximum profit, is for your shares to get called away. It means you're making a profit. Okay, I think a big mistake a lot of covered call investors make is they sell out of the monies. And I mean, on the surface, it sounds wonderful. I mean, I'm going to make this money and I'm going to collect this premium. But the problem is, if you're only getting $50 or $100 for premium, and then the stock takes a nose tumble, well, then guess what? You lose. And I mean, you can talk to yourself all day long in the middle of the night, oh, it's only a paper loss. Well, you know what? I'll take my non-paper profit over my paper losses, you know, just to take in the less risk. So that's why I advocate selling in the money covered calls. Okay, so again, 100 shares, 1 contract, and then if you were to sell 100 shares, remember the price of Nugget was at $33.32. So if you want to buy 100 shares, you need $3,332. If you want to buy 200 shares, you need $6,664. And whatever money you spend on the shares should be 25% of your total portfolio or your account. So 25% of 100 shares, you would want to have $13,328 in your account. Because if you had that $13,328 and then you spend $3,332 to buy the 100 shares, that'd be 25% risk. Okay, 200 shares, you'd need a lot more. You'd need $26,656. Tongue twister there, right? Okay, and by doing this, you make it a habit to practice good risk management skills. I've said this multiple times. You don't want to put all your eggs in one basket, and it also builds patience and wealth over time. Okay, so even though it may look like a really crazy growth strategy, it really is more of a long-term investing style, something like regular investors would do. So make it a habit to practice good risk management and scale in slowly with low risk. Okay. Now, I advocate shorter expiration days. So if you're not comfortable with the $30 strike price and you wanted to sell the $25 strike price call options, and you would need to go 2 or 3 months out, then my recommendation would be don't do that. Wait until the price of Nugget goes near those levels and then do it, and then you could sell the 2 week or the 3 weeks. I think anywhere from 2 to 4 weeks is a good opening position. Okay, that way the shorter expirations collect your premium faster and you can make profits. Shorter expirations are also easier to roll out because if the stock does drop in value, then you will want to roll out your covered calls. And if you've already sold an option that's 2 or 3 months out, what are you going to do? Sell 4 months or 5 months or 6 months or a year? Eventually you're going to run out of time, right? And also, shorter expirations are more flexible. If you have your money tied up for a year because you sold a 1-year covered call, that's a lot less flexibility, and there might be other opportunities out there. You know, all the opportunity, I mean, there's so many opportunities. You're never going to get all opportunity in one single stock, okay? So, after you've done that, after you've bought your shares, you sold your covered calls, and you sold in the money covered calls, and you got your position all set up, if the shares go up and the shares are rising, it is more likely that you are going to collect the max profit and the shares that you own are going to get called away. And that indicates growth of the stock or the ETF, and you can create monthly profits in your portfolio. So you want to buy more shares and open a new position at a longer week out, and you can create kind of like a laddering system on what you might do with bonds. Okay, people do this with bonds all the time. They buy municipal bonds for 1 year or 2 or a long term. Maybe they'll buy a 5-year bond, and then after a few months they'll buy another 5-year bond, another 5. That's kind of what you're doing with this covered call strategy. If the shares are going up, open a new position, buy some more shares, and sell another in the money covered call. And you will create yourself a regular profit, almost like an income, except you're not spending the money. Your money is going to grow, and you create almost like an income. Okay, if the shares are dropping, if they're going down, then you roll out the options that you sold. You sell a lower strike price, or you could sell a longer expiration date. And if the price drops so fast that you have to roll it out longer than 3 months, then I say get out of Dodge, wait for things to settle down, and then get back in when it hits the bottom and it starts settling down. Okay, so this is the strategy that I use with success in Nugget. Okay, and it's kind of neat. It worked out like the 7 steps of highly effective traders, or you know, famous book out there. But anyways, number 1, find volatile investments with liquid options. 2, identify support levels. 3, check the premiums. 4, scale in slowly. Practice good risk management. 5, sell the shorter ones over the longer ones. If you're not comfortable with the levels of support, then just wait until the price goes down and then do it. Okay. Number 6, buy more shares if the stock's rising, open new positions, sell more covered calls, and roll out the laggards. Okay. And then finally, if the stock is dropping so far that you have to sell more than 3 months out, then get out and wait for things to settle down and get back in. Okay. And I went to the trouble of putting up a transaction. These slides here, and you can pause the video. Okay. This is from December the 27th, and here's the second slide here, and here's the third slide. So if you want, you can pause the video, and this is the covered call strategy that I use for success. And if you were to add all the red numbers and add all the green numbers and subtract the red total from the green total, you will see that I am ahead $763.39. And I use the covered call strategy on this. And so you can pause the video on each of those slides, write it down, see what I did, see when I got in, when I got out, and so forth. And you will see that it worked very well for me. Okay, so this is what you want, ladies and gentlemen. You want your egg to grow bigger and bigger and bigger, and this is just one of probably 100,000 different strategies that you can use out there. Okay, I say that investments don't make or lose money. Investors make or lose money, and the way investors make or lose money is with their strategies. People love to blame stocks and the market, but you have to look in the mirror. Why are you the one that chose to buy a stock that's going down, or why are you the one that decided to short sell or buy a put option or whatever? You are the one that makes the decisions. The market doesn't make those decisions for you. So it is your strategies that's going to make you money or not. Okay, so That's it for this video. Thank you for watching. I hope you enjoyed it, and I will see you in the next video.